Hi, Jeff Rainwater, John L. Scott Real Estate here, answering your real estate related questions. This is a great question. It's related to taxes, so I wanted to make sure to preface this by saying I'm not a tax attorney, so this is not should not be considered tax advice. If you want tax advice, consult an accountant or a tax attorney. Um, but it's related to real estate, so I thought this would be a great question to bring up. And the question is, I have been able to use depreciation from my rental property as a tax deduction each year, but this year it went up in value. Does this mean I can't use that deduction anymore? Okay, so to understand this, you have to separate in your mind the value of your home and the appreciation and depreciation as two different things. The value of your home can go up, it can go down, but your home is going to continue to depreciate in value, so you can still use that as a deduction. So yeah, you definitely can still use that as a deduction for that property, even though the value went up. And this is a great timing on this question because for quite a while now we've been seeing prices go down, and then this year prices have been going up. So so it makes a lot of sense that you would wonder, oh, can I still continue to use that as a deduction? And yeah, you can. Cars, for instance, when you buy a car, the government looks at the depreciation on that as a 5-year span. Okay, and what does that really mean? As you drive the car, it's pretty obvious that you're going to kind of wear it out. Everyone knows that after a certain amount of time you have to go get it serviced and that kind of thing, and things start to go wrong with it when you get a few 100,000 miles on it and that kind of thing. So um, the government looks at a 5-year depreciation lifespan on a car. For a residential real estate property, you look at 27.5 years. Okay, so how do you determine that, right? What you want to do is you take the purchase price that you bought the home for plus the transaction costs. So your escrow and title fees, all your closing costs in there. So the purchase price plus the closing costs, and then subtract out the cost of the land. Okay, so you have to kind of separate the improvements or the buildings from the land. And the reason is the most assets and improvements to the properties are going to deteriorate over time. Your roof is going to need to replace, your siding gets old, foundation will eventually crumble to dust, hopefully hundreds of years from now. But the land is still going to be there. The land's not going to depreciate in value, right? So that's why you can deduct depreciation on the purchase price plus transaction cost minus the cost of the land. Now there are some exceptions, but they're few and far between. An example would be if you have oil on your land and you're drilling that oil, well then of course you can depreciate the cost of the land then because you're drilling the oil every year out of it. So, but for most residential properties, not a concern. So that's, once you figure that out, you multiply that times 1 divided by 27.5, and that'll give you how much you can deduct on that. Now, why is this a tax shelter? That people can use this as a tax shelter is, let's say that you figured that out, and you look at your home and you're going to take $5,000 deduction on your taxes when you figure out all of the tax deductions. Basically what a tax deduction is saying that you're not taxed as if you made that money. So that $5,000 that you made at your job, that you normally would have paid taxes on, you now are not paying taxes on that because you have a $5,000 deduction thanks to your depreciation on your house. So it's kind of a little tax shelter there. Now, eventually, when you sell that house, you're going to get what's called a capital gains tax. Now, the advantage here is a lot of times, depending on how long you live there and that kind of thing, your capital gains tax could be much less than the income tax that you would have paid initially on that same amount of money. So you can be taxed on that $5,000 at a much lower rate. So that's kind of the loophole. So just one more great reason to invest in real estate. So what a great question that was. Again, I'm not a tax professional. I'm just a real estate broker. But that hopefully will give you a little bit of an idea of why can you deduct depreciation and how that works. So yes, the answer to your question is absolutely. You should still be able to deduct your depreciation of the value of your property there, even though the value of your home went up. All right, so great question. Thanks for asking. If you have other real estate questions or just topics related to real estate that you want to hear me cover, I'm happy to do that. And I will the best questions, I like to make videos about so other people can learn. And certainly, if you're looking to buy or sell real estate in the Pacific Northwest area, give me a jingle. You can email me at jeffrainwater@johnlscott.com. Thanks, and keep watching.